All right. So a very warm welcome, everyone. Good morning, good afternoon, and evening. A very warm welcome to our webinar, Silver Linings Playbook for the CRE Industry, How to Build a Resilient Business Model for Tomorrow. Subro, Director in Lending Services with Equity Knowledge Partners, and very privileged to be the moderator for today's discussion. But before we really deep dive in, from a housekeeping perspective, we request all attendees to please be on mute during the session. We're going to have roughly 50 minutes of very interactive session and then followed by a Q&A and final closing comments. To ask a question, please submit it in the Q&A box at any time during the discussion. We will be addressing them during the Q&A session, and if we run out of time, we will be responding back after the webinar. And we have a great attendee turnout today, including some senior leaders across the industry, across different functions like underwriting, portfolio, and asset management, including risk and credit offices, from a very global audience again, from both global and regional financial institutions and lenders. Thank you all for your time today. A quick introduction to Equity. We are the leading provider of research and analytics solutions with over 500 global financial services clients today, including some of the leading investment banks, corporate, commercial, regional banks, credit unions, mortgage brokers, asset managers, and PE and VC firms. We have seen unprecedented growth over the last 2 years, whereby we doubled our size as an organization. And for lenders, we are a one-stop shop, supporting clients across investment banking, sales and marketing, KYC due diligence, credit risk management, analytics and insights. Specifically in lending services, we have expanded our offerings to areas like loan operations, trade finance, treasury, cash management. That said, CRE industry is one of our core focus area. Our bespoke solutions help our clients achieve better ROI through driving efficiencies, adopting technology, improving risk management, and everything in a very cost-effective manner. Our services, are across the entire value chain, from origination, underwriting, post-closing, portfolio monitoring, and servicing. So, what is the focus of our discussion today? If we get into this, right, the market is absolutely evolving in terms of macro and industry landscapes and how different CRE lenders are really strategically looking at driving growth and managing risk. Now, let me now hand it off to our panelists for their introductions. And, Arvind, would you like to introduce yourself, please?
Sure. Well, firstly, thank you for inviting me to this panel and all the rest of my colleagues on this panel. So thank you for that. I'm currently head of Underwriting and Portfolio Management for the commercial real estate lending arm of Natixis in the US. I cover all 4 of our underwriting verticals that we do here. We have a balance sheet lending program. We have a CMB, a SASB lending program. We are a CRE asset finance lending program, which essentially is warehouse lines for loans being accumulated for CLO takeout or note-on-note financing. And then we also have a CRE corporate finance line that's secured and unsecured, corporate RCF to REITs. So I had all that in terms of underwriting and portfolio management in the US. Prior to this, I was at BlackRock for over 10 years, had various responsibilities, including managing investments for the high yield commercial real estate debt fund, as well as spending time at the Financial Market Advisory Group, where I was managing asset wind down portfolios for the Federal Reserve, as well as advising central banks on stress CRE loan management, during the financial crisis.
Thank you, Arvind. I must say, very deep CRE experience as well as, with significant market presence. With that, let me now hand it off to Corey from Citizens. Corey, would you like to please introduce yourself?
Yeah, absolutely. Thanks for having me. I'm really excited to have this call this morning and not only share my insights, but certainly learn from some of the professionals we have here on the phone today. So Corey Dendy, I head up underwriting and portfolio management for the commercial real estate group at Citizens Bank. We are a national platform. We have commercial real estate offices in 14 various states. We offer both fixed and variable rate. Obviously, the fixed rate program right now is likely not the not the cup of tea for us, given where rates are going. I know we're going to discuss that a little bit later today. Prior to coming to Citizens Bank in 2008, so I've been here since 2008, but was at Wells Fargo, Wachovia, Bank of America, as well as U.S. Bank. I've done just about everything in commercial real estate, from being credit officer, being a workout officer, and started my career here at Citizens as being a covering relationship manager. Over 30 years of experience in commercial real estate, so have been through multiple cycles and hoping the cycle we're going through right now will prove to be shorter than what we have seen forecasted. But thanks for having me.
Thank you, Corey. I'm glad, very privileged to have you as well as one of the panelists. And now let me hand it over to somebody who has done a lot of transformation within this market. Ken, please introduce yourself.
Thanks, Subro. My name is Ken Schroeder. I'm the Senior Vice President responsible for operations within our commercial mortgage group at KeyBank. I've been here at KeyBank for over 24 years in various roles and responsibilities with technologies, loan servicing, operations, originations, and oversee all of our operational effectiveness, including the relationship that we have with Acuity and our offshore work that we have them do for us, which we'll talk about later. I'm excited to be here. I almost wore my Chiefs jersey today, being here in Kansas City. There's a big American football game tonight, so just a plug out to the game tonight. So look forward to our discussion.
Thank you, Ken, and all the best for the game. And finally, somebody who knows and who are building contextual technology. Laura, please introduce yourself.
Thank you, Subra. Hello, everyone. Excited to be here and to learn from leading lenders on the panel. I'm Laura Krashakova, CEO and founder of Spacequant. Spacequant is a technology company. We digitalize, automate, and make more intelligent many workflows across the whole loan lifecycle, commercial mortgage loan lifecycle, origination, underwriting, asset management, and closing. Large institutional clients, including, in fact, KeyBank, GLL, Pacific Life Insurance, use our technology across different processes for mortgage underwriting and asset management. And excited also to share with the audience today, our most recent product is industry-first origination portal that helps lenders to increase the volume and, most importantly, quality of their loan origination from their past borrowers, existing, current borrowers. It actually also brings new relationship to the lenders, new deal flow. So I'm excited to share our thoughts and our insight on technology, as well as what we're seeing in the commercial real estate space.
Thank you, Laura. And I'm sure, everyone is eager to hear. Why don't we straight dive in? So Arvind, let me bring you in from more of a macro perspective. So with rising rates, increasing construction costs, expected GDP contraction, what do you think, where do you think this market is headed to, and how it will be impacted? Will all asset classes or property types essentially have the same impact?
Well, I think that's definitely a question on everybody's mind today, on both sides. Definitely it's a challenging environment. We're seeing, it's a very uncertain environment. We're seeing interest rates that have increased at unprecedented levels, all the way since 2006. And it's, I think from my perspective, at least, I think a lot depends on, how the Federal Reserve is able to actually navigate the inflation back to their comfort zone, whether it's a hard or a soft landing. That will really depend on if it's, I would say if it's a soft landing, they will have higher interest rates for longer. If it's a hard landing and there's a significant recession, they may reduce interest rates again to start growth again. But in general, what I would say is that if we have got high interest rates for some time now, and as we know, higher long-term interest rates are generally lead to kind of higher cap rates. So I think we can expect higher cap rates, if expectations for long-term interest rates remain. There is kind of some uncertainty there. The 5-year swaps are higher than the 10 years at this moment. So there's a partially inverted yield curve, which kind of points to some moderation in the longer term interest rates. But in any case, I think if in the higher interest rate environment and assuming, you have some cap rate increase over there, I think it'll affect, differently across different property types. I think multifamily will probably be the least impacted, mainly due to the short-term nature of leases. Rents will increase with inflation, hopefully, and they'll be rapidly recalibrated. We're kind of currently already seeing that. We're seeing higher rents everywhere across the board in multifamily. Of course, the more recent data shows rental rate increase is decreasing, but I think it'll still remain positive unless there's a very, very significant recession. The other, kind of headwind on that front is lower affordability for single family homes with higher interest rates for people. So people are kind of moving to rent rather than buy, since many people can't afford it. I think so I think multifamily will probably be the least impacted in terms of pricing. I think industrial and self-storage will also be less impacted. There's strong demand for that. Again, some of them have short average lease terms, so they should be recalibrated quickly. Hospitality may be impacted if there's a deeper recession, but I think the leisure hospitality market is doing pretty well right now. So I think there's some comfortable cushion there. Office, of course, is a very different story. The long-term nature of leases coupled with the uncertainty regarding, demand for office space going forward due to, companies' work from home policies and what kind of the new normal would be, makes it a really, really challenging space to be in today. I think there will be significant repricing on office space, especially in the Class BC. I think there's probably going to be conversion of office space into other uses, especially in large cities like New York City and San Francisco, LA, where there's a lot of available vacancy now and much higher in the Class BC space. In terms of retail, I think grocery anchored retail may also be less impacted, but high-priced high street retail may be more impacted in a deeper recession. But let's be honest, retail's already kind of taken even pre-COVID, there's been a significant correction. I would just say, one tailwind that we have is because of high construction costs and the supply chain disruption, is there's just been, much less supply that's come underway. So that should help. And it could, if things suddenly grow through, returns really fast, you could have a pretty significant repricing in rents and increase in rents, etc. in that situation. We haven't, again, seen that happen as yet. The repricing hasn't happened as yet, but I think we witnessed people are more in a wait and watch environment here. Investment sales have dropped by more than half across. Some of the largest brokers have mentioned this year that they haven't done almost any office transactions. So, I think people are just kind of waiting and buyers and sellers just holding out till there's more clarity on long-term inflation expectations and interest rates.
No, thank you, Arvind. And again, a lot of uncertainty, mixed bag. So Corey, what's your experience on this? Would you add on to, highlight any further areas which should be, noting worthwhile?
Yeah, I think, Arvind, just kind of laid it out and almost sounded like when we're sitting around the table and trying to decide where the risk areas in the portfolio and where are our opportunities to grow. Everything that he just laid out is a conversation. And what I would take from that is for lenders that provide balance sheet debt, as well as institutional equity, uncertainty wreaks havoc on decisions that need to be made. And certainly, Arvind just laid out a lot of uncertainty. And so what it does is I'll separate it, kind of into two categories. So from an underwriting and origination standpoint, it's really hard to get a handle around how a property is performing today because of the uncertainty. You're looking at rising rates. So what do we price this loan with rates moving daily? That becomes a challenge. A bigger challenge for us in commercial real estate is unemployment. Unfortunately, unemployment is low, even though we're in an economic contraction. And so you kind of got to look beyond the numbers and project almost where do you think unemployment is going to go between when you originate this loan and when do you expect to get repaid. And it's that delta of I originate today, it matures in 5 years. And so what do I think unemployment is going to look like when my loan is maturing and our sponsor needs to go out and either refinance or sell that property? Unemployment plays a big rate, not just what it is today, but as we get closer to maturity. The supply chain for those of us that still do construction lending, a project, can it get built? Will it get built on time? If there are disruptions in the supply chain, and certainly we know what's going on right now with the rail industry, and it seems like they're going to come to an agreement. But all of those things add additional uncertainty as to when this product is actually going to deliver. If it delivers late, there's a great likelihood that you're going to have some cost overruns. But more importantly, it's going to stabilize late. And projects that stabilize late tend to get refinanced out late. And so that uncertainty around there. I'd go back to the second part of this, which is likely the most challenging for us that both manage origination and portfolio management. So you booked a loan 2 years ago, you felt really good about it. So pre-COVID, all the numbers were great. But this loan is going to mature in the next 2 months, 2 years, while we're going through this economic uncertainty. And so we certainly had an expectation that over the life of the loan, it had this profile. And based on all of the uncertainty that Arvind laid out, that uncertainty leads us to want to reassess the expectations of how that loan is actually going to perform. And those are likely some of the more difficult conversations that we have internally, is really trying to forecast where do we think this loan is going to be, and then adequately setting up reserves based on that forward-looking forecast. So uncertainty makes all of that a lot more challenging today than it was maybe 2 years ago pre-COVID.
No, thank you, Corey. And I guess that kindly also tells us that what do you think will be the key priorities for lenders? Because there's a lot of this uncertainty, right? You still need to drive growth. You need to manage risk very prudently. So what do you think would be the lenders' priorities?
Yeah, I think Arvind laid it out. Multifamily, I think we remain bullish on multifamily, and whether that's a multifamily project that a sponsor wants to purchase as a value add, do some heavy CapEx work and drive rents, or if it's just a stabilized multifamily that they want to sit on our balance sheet for the next 3 or 4 years, allow the market to stabilize and then go out and sell it. So we still feel really good about multifamily. We feel really good about grocery anchored retail, and I put an emphasis on the grocery anchored aspect of it. It certainly has survived, COVID and the downturn that came with that. From our portfolio, the metrics show us that it has still outperformed the rest of retail. So we feel really good about retail, grocery anchored retail. We were bullish on industrial. But when Amazon makes an announcement that they're the 800-pound gorilla and they're going to take less space on a go-forward basis, it does make you want to reassess when you're doing a brand new ground-up industrial project, having a really good handle on who will your potential tenants be, and making sure that your sponsor is not looking to just build a building for an Amazon. I do think that dichotomy of American purchasers wanting to continue to purchase more online gives more breadth and depth to the industrial space. And so we still are looking at industrial projects, but it really has to fit a really specific pattern of location, access, and then the demographics around being the last mile, and what are those demographics? And are those demographics not only showing us a buying capacity, but can they also show us the number of users in that demographic that have a proclivity to want to shop online versus still going into the store? I think once we get a handle around all of those, we're usually green light. But those are 3 asset classes that we feel really good about. Arvind hit it out of the park. We are really concerned about office. I don't think any of us really understand what office is going to look like in 2024, 2025, because the whole work from home has not worked its way through the system yet.
Yeah, no, absolutely agree with that, Corey. And so maybe I can turn to Arvind now. So Arvind, different asset classes, different approaches in risk management, as well as, what would you say would be the best practices? What is a prudent risk management approach during these times?
Well, I think in addition to what Corey just mentioned on actually underwriting forecasting of performance of the individual property types, I think in general, firstly on the lending side, as you know, both CMBS and balance sheet rates have gone up significantly since last year. Balance sheet has kind of lagged CMBS market, but that's going up as well, and so I think that's kind of recalibrated people's expectations. Unfortunately, I think, well, maybe I should take that back, but I would say that values have not kind of recalibrated at the same extent as yet. They're being a little sticky, even though interest rates have gone up significantly, risks have gone up significantly. Values are still kind of, and I think maybe that's sometimes the appraisals are a lagging indicator, and they're based on historical data, so they're really not great for projecting what actually is happening in the spot market for values. As I mentioned, for values, spot markets really transactions that are happening, but those have really fallen off a cliff. So there's almost very little, like the investment sales markets really fall, so it's difficult to kind of see what is happening. So given this uncertainty of where values are, I would suggest, we focusing really on debt yield and DSCR rather than LTV in the current environment.
Yeah.
I would think that, you really want to, and look, this is going to impact borrowers, right? Because they're used to seeing leverage, and if they see loans at 55% LTV and they were getting 70% before, you get this kind of pushback from them. But we're really focused on debt yield and DSCR based on this new normal of interest rates and what's happening on that front. And so our concern is more on that. And unfortunately, since prices haven't recalibrated, it looks like a really low LTV. So that's I would suggest focusing really on that. I would say you should assume really higher long-term interest rates as a base case and ensure you have kind of sufficient DSCR cushion. And I would also say in this situation right now, given the uncertainties going forward, you want to also plan for a downside that's maybe of a more severe recession, and test your cash flows cushion that you have there. If rents decline, if vacancy increases. See if you can really sustain your cash flow, your property can still sustain DSCR on those situations. Also, I think in a situation like this that we've kind of seen from the previous global financial crisis is borrower liquidity, right? That's really important to carry property through, potential recessions. And we've seen that in the last global financial crisis. You had good properties, short-term liquidity issues for a year or 2 years, and the property performance comes back after that. But if borrowers just don't have liquidity to even sustain themselves for 2 years, it becomes challenging. So I would say focus on liquidity of borrowers, forecast a potential 1 or 2 year, recession in the short run, which may happen, and make sure you have good cash flow cushion on that. And I would say if you're kind of doing transitional lending right now, multifamily lease up or something like that, then, you really want to focus on, making sure you get taken out, your takeout financing at maturity, when the asset is stabilized on a pretty, I would say conservative, stabilization numbers. You want to make sure, and then, focus on it. Can your takeout financing at a higher interest rate and some amortization, sustain does your DSCR work at that point, right? I think that's a pretty significant focus that, we should look on. And it's basically recalibration of where we think the takeout financing is going to be, much higher interest rates and, some amortization.
Yeah, no. Talking of recalibration, Arvind, very rightly said. So, Corey, a very interesting concept here. When we take the word recalibrate, what do you think? Lenders or typically large regional banks, they have been on this transformation agenda, looking at tech, digitalization. It's time for them to recalibrate. Do you think it will take some pause, or what role do you think tech, data and analytics, things like location analytics? What role do you think they would play?
Yeah, I think it's increasing, more and more. When I first got to the bank in 2008, literally everything we did was manual. Originations were manual. We actually took manual signatures. For some of those on the phone may not know what I'm going to say next, but we actually faxed signatures back and forth to get a deal approved. Annual reviews, modifications, everything was paper-based. And so from 2008 to where we are now, our entire, well, I shouldn't say entire, 90% of our origination process is digitized. It's an online form where we're putting in all of our information, and that helps us to be more efficient on the back end. We're not all the way there, but certainly we've made great progress. So I think what we'll see on a go-forward basis is even more digitization of the underwriting process, of the approval process, and the post-closing process. I think end-to-end underwriting is likely where most banks aspire to be, to where everything from the first word written on a document from an approval package to the entire approval is 100% online, no more paper, whether that's Excel or Word. The last big hurdle, I think, for banks, and I'll speak for our institution specifically, is having a better grasp and a better use and execution of AI and machine learning. I think that predictive analytics are the way to go. I think that is the future of not only banking. We've seen it in other industries. You think if you can get online and get a credit card approved in 30 minutes or less, yet it still takes us significant time to have a commercial real estate deal approved. Now, I don't suggest that commercial real estate will ever get to a 30-minute approval process, but certainly we can evolve in that and become more efficient. The more efficient we become, the more time we free up for all of our underwriters and PMs and credit officers and RMs to spend actually thinking about the transaction, about the deal, about the next customer, about the next segment. So every minute, every hour that we actually free up, we give hours back to our employees to do more of what they do best, and that is have some critical thinking around our portfolio. I do think the predictive analytics will help us a lot. We still make a lot of decisions based off of, I remember I had a loan like that 5 years ago, and it behaved this way, and so I'm going to predict that it's going to behave this way again. And we all know that's really faulty thinking. So I think the next big wave is having some form of predictive analytics that actually help us make decisions in these uncertain times that we're in right now.
Yeah, no, excellent, Corey. And I think, Ken, I guess you would like to add something here as well, kind of trying to blend in this.
Yeah, I would say, Schroeder, that Corey really resonated with me when he talks about critical thinking for our staff. When we're looking at trying to drive these technology initiatives, how does the role of the domain experts play in this? And really, we want our staff to be focused on high value add activities. At the end of the day, we don't want them to be doing administrative work and doing data entry, especially doing data entry in multiple places, with the same information. So, first and foremost is we're looking to focus their activities on that critical thinking status. However, I often say, and people will hear me, it takes a village. We can't rely on everyone to be experts in process automation. We can't rely on that senior underwriter to envision what the future could look like for AI automation. So you got to find those right people to be able to envision what the future could look like. Because, let's admit it, our underwriters and PMs that have been working in Excel for the last 20 years probably aren't visionaries, right? If they're visionaries, they're probably not going to be working at some of the banks that are on this call here today. So there are those that are creative and that think outside of the box, and they're open to new ideas. And those are the ones that we really got to tap for these projects. And I think many of us are on this evolution and this transformation. It's an arms race right now to leverage technology in a way that is going to give KeyBank a competitive advantage, and all of us are working towards that. I would say one of the things that help with that is having some of those visionaries embedded with the business users. So, for example, I sit with the users, and I'm responsible for operations and being effective and having effective processes there, and it's really allowed us to be closer to how those users do their jobs. And we are also asking for people to speak up and say, if you have, an idea or suggestion for improvement, that we can do that. But, these things start at the top. Senior management really should have some aspect of operational efficiencies as part of their yearly strategic goals. They should be measuring themselves, they should be measuring their staff on how can they make things more efficient, either through the use of technology or through the use of offshoring and vendor selection. So those companies that really embrace efficiencies as a core competencies are the ones that are going to be leading in the areas going forward. One practical example I would say, Shubro, that we do here at Key is we have a group in our servicing area that has a program called Act Like an Owner. And this team engages ideas from employees and evaluates them on a cost benefit analysis, and then champions them through, process evolution and through technology enhancements with our vendors and with our groups, and provides monetary rewards for those that come back and give ideas to make processes more efficient. So that's one example that I wanted to highlight here that really has helped us build a culture of continuous improvement.
No, thanks, Ken. And again, I strongly believe it's very, very has to be, experts driven. So talking of data analytics and, a single platform, but has to be useful for the underwriter. Then we're very aware of, the business analysts and why is it so required that, they are close to the underwriters. But yes, Laura, maybe I can bring you in here because there's a lot of expectations on technology, right? A lot of expectations on what data analytics can do. So, what is the art of possibility here? Laura, you're on mute.
Right. Still haven't learned how to use Zoom after all these years. Yeah, thank you, Subra. Yeah, would love to cover generally digitalization and automation. We have a lot of practical experience in this area, as well as AI and machine learning, which are buzzwords, but still very increasingly becoming more and more important across all industries, including commercial real estate finance. One of the, for the benefit of attendees who may not be familiar where automation is right now in commercial real estate finance space and what is already possible to do today, maybe I can provide some practical examples. So we work with many lenders and asset managers in this area, and specifically to Arvind's point earlier, for example, for Natixis now is important to look at DCR, look at cash flows. Now, if you're looking at cash flows, it could be a pretty tedious process to go through property financials, to go through rentals and see and stress test the rental, stress test the financials, and to see what kind of DCR you can expect. Now, if you do it manually, this is many hours of work. Now, also, if you think of it, that many loans may not be even work out for you at this for your lending institution at this point, just because they don't fall into the DCR bucket. Now, the lending officer needs to go through a lot more loans, a lot more lending opportunities in order to pick the one that they're ready to lend on. So it becomes increasingly more and more difficult and taxing, both for the bank, expensive for the bank, and taxing for employees. Now, what is possible already with technology today is convert this multi-hours long process. Literally, you can do with the same level of detail and sophistication, you can do the same analysis within minutes with the technology, which is able now to extract data from documents, standardize, convert it to the same common denominator. You can stress test different rent assumptions, vacancy assumptions as well to see where DCR will fall into, what bucket this DCR will fall into. And all of this is literally is possible to do within minutes. In this way, the lending officer, the risk officer can go through multiple scenarios and can quickly discard opportunities that they don't want to spend their time on, or dig deeper into further underwriting and origination process. So this is extremely important. New technology is extremely important, especially during uncertain, challenging times, both at the origination stage and portfolio management as well. On the portfolio management side, what we see, we actually now preparing a case study based on COVID. It feels like commercial real estate going from one issue to another. We just came out of COVID almost, and now there is another issue of recession and interest rate hikes. So we are currently working on a case study with one of our customers, which is a large bank, large lender with 10 billions of commercial loans in the US. And in fact, they have significant exposure to office, retail, hotels, a little bit of multifamily. So all the most risky food groups. And not surprisingly, they have been under extreme scrutiny from regulators, from auditors, from their internal management, and different external stakeholders as well. And they used to be, and they're receiving hundreds of financials, hundreds of rent rolls from their borrowers on hundreds of loans that they manage every quarter. And what used to be, they have to manually go through these documents to answer certain questions. And it was taking, to process these documents was taking them a team of 7 asset managers several weeks just to process each batch of documents. Now with technology, they are able to do all of this analysis literally within days, 1 or 2 days. And that gives them huge advantage. They're able to, first of all, see themselves what's happening with their portfolio pretty much in real time as soon as they get documents from the borrowers. They can answer very detailed questions like what tenants moved in, who moved out, what are the changes in vacancy in each specific property and across the portfolio, what is their exposure now to specific tenants within the portfolio. And most importantly, they were able to answer questions from regulators, from their other external stakeholders, which for them was extremely important. The faster you can answer those questions, with more detail you can answer those questions, the easier it is for them to continue managing their portfolios. So this is where technology was really powerful.
No, thank you. No, thank you, Laura, for that perspective. And, when I follow this space quite closely, right, and how things are changing, and I guess not with everybody, we are not there yet today, like thin file customers, and won't really, more from a global level, things like, alternative credit data, etc. But really talking about, this is the art of possibility within technology. So eliminate, take away redundant processes, Corey, what you were talking about, digitize. But what about move? So Ken, maybe I can ask you, what about, bringing in some of the non-value added work offshore to strategic partners, while a combination of these 3 can really drive ROI in this time?
Yeah, so Subro, we've been working with Acuity for 9 years in my particular group. We have over 250 analysts at Acuity that support many different areas of KeyBank. But at the beginning, we were extremely hesitant to get started, and our CEO just said, you gotta dip your toe in the water here. And we did our analysis, and every firm that we talked to in commercial real estate was not successful. Now, this was a while ago, and that was outside of the large captives that are in our industry. And we continually heard the comment that you're going to struggle with retention. One of the common items that are out there is, as soon as you build up a staff, they're going to leave. You're going to continually be investing, and you're never really going to get the quality that you need. So we've been partnering with Acuity there, and we have made that investment and have been very successful at it. I would say that we value Acuity as our partner, and we see them as an extension of our staff and look to them as our third shift. Work is sent to Acuity each night and is returned to the onshore analyst the next morning. And this has allowed us to create a shared resource pool that will flex based on the priority and the work volume. The other thing that we've done that, it's not rocket science and it's not unique, but we've also expanded our business analysis staff and our reporting staff to be able to provide support for system upgrades and reportings and regulation that we have. So overall, when the system support staff sit with the users, they're able to work together and identify how things should work and provide situations where we really need to focus on. So over the years, we've been able to have a significant amount of value added there by the collaboration that occurs offshore. And I think you've also talked a little bit about the technology and how you can get value from technology. So I would let one of our other panelists to kind of talk through the significance of valuing technology in the vendor relationship that we have in that space.
I guess Ken referring to me. Yes, we are. We work with KeyBank as well as Acuity on transforming both origination and servicing, and we also what we're seeing through our conversations with our existing customers as well as prospective customers is it is increasingly more and more difficult for financial institutions to find the right technology, just because there's such a proliferation of different applications, features, different providers, and everybody sounds great. However, commercial real estate finance is a very complex space, and the technology that is needed to digitize, automate, make more intelligent is also very frankly needs to be complex. And finding the right partner or rather partners is a difficult process, especially in the industry that may not be as experienced yet on the technology side. And it's really just gaining this experience now. So one trend that we are seeing is, I think many of the large institutions have preference. Ideally, they would like to have one solution that does it all, which may have been possible several years ago. But what we're seeing in the residential real estate, as well as in technology in general, the velocity of change on the technology side is only increasing year over year. And the sophistication of technology is also increasing. Now, not a single, I don't think even the largest lending institutions can really afford being able to keep up with all of this technology, being able to build it internally, especially given how fast it's changing, how more and more complicated it is becoming. So it's important when lender considers whether they should build, buy. It's important to Sorry, I felt like there was some echo. It's important to build internal systems in a flexible fashion to make sure that it's easy to add or remove different external applications, third-party applications. Because what we are seeing is lenders and other large financial institutions, they will be becoming more and more increasingly dependent on being able to add additional services. They will not be able to develop everything internally.
No, right. No, Laura, I kind of, agree. But, another view could be having the right data integrity, because that becomes absolutely necessary, even when you're looking at automation. And then, having the right data being fed into the system so that the decisions are correct, even you're looking at, an AI or an ML model. Maybe, why don't I, hear a little bit from Corey or Arvind? What do you think, Corey? Does this resonate? It's more automation. How soon can we be there?
Yeah, I think you hit it. You kind of hit citizens right between the eyes. We've evaluated, several, technology partners, to help us in this evolution we're going through. And I will tell you, we've spent more time in the last 18 months internally because of data integrity issues. Making sure that our data was clean. I don't know that historically we had data in such a manner that it was readily retrieved from the system. If you can't retrieve the data, certainly it's no longer actionable. And so from that standpoint, I think we're doing a much better job from a data integrity standpoint of making sure that the underwriters and the PMs understand what we're looking for. We've come a long way with the digitization to help with that. But I think your point is really relevant. It's one that we struggle with on a day-to-day basis. and making sure that the data into the system is useful so that when we pull it out, we get the expected results. And from our last 18 months, what we witnessed was, here's what we expected. We pull all these reports out of the system, and the results were not nearly what we expected. And so we kind of went back to the front end of it from a data integrity standpoint. We train PMs and underwriters on what we're looking for to go into the system. And so I now think that we're probably getting closer to a point where evaluating a third-party partner makes a lot more sense today than it would have 18 months ago.
No, absolutely, Corey, and I could not agree with you more, because increasingly we are also partnering with several banks who are kind of asking us where we get into discussion of how we can improve the data quality, which gets into this decision, because the machine is as good as the data which kind of it's being used to train, right? I mean, it's how it is. So I think to conclude, right, to summarize, essentially, as we heard from all of our learned panelists today, did CRE, it's interesting times, but still CRE lenders, I still believe, need to navigate through transformational shifts in the industry. Lenders needs to be innovative to meet the evolving needs of borrowers, investors, and there's obviously huge potential to unlock value, either through technology as well as through strategic partnerships. Specifically when you're looking to drive operational efficiencies, capacities, and even driving growth. Finally, this is I think it's more of a cultural thing as well. So organization needs to change now, needs to think to change now, because either structurally or technologically or culturally, because, and I believe what we heard from all of you today would have given food for thought for building a very resilient model and driving growth. Now, I can now request our attendees to submit the questions on the Q&A box at the end of the screen or the bottom of the screen. And with this, I'm very, very happy to introduce Dr. Paul Alapat, our Chief Product Officer, who is an industry veteran with over 25 years of experience in international capital markets. Specifically, as we're talking of economic cycles here, he was Chief Economist with Nomura, as well as regional financial economist at Lehman Brothers. I would let Paul speak. Over to you, Paul.
Thanks, Shubro, and thank you, every one of you on the panel. Thank you, Arvind, Corey, Ken, and Laura, for volunteering your time and your thoughts during a very uncertain period that we are headed to. As far as economists go, this is not a normal business cycle. Essentially, the debate is how severe is the stagflationary outlook ahead. And as you know, stagflation is something that we haven't experienced seriously for almost better part of 30 years or longer. So it is going to be very, very challenging. And accordingly, I think this question about which asset classes would benefit or get harmed is appropriate, because this is not your regular recession that we are looking at. On behalf of Active, again, thank you to all the participants who have joined us today, and hopefully you have benefited as much as we have. Among the 7 business lines that I oversee, lending is our fastest growing. It is the business that has doubled over the last 2 years. And this year has been a particularly satisfying one, where we've added a record number of new logos. And I think it's essentially the expertise, the access to a global talent pool, over a decade of working with large business partners. We have established a certain amount of credibility and domain depth. For us, we know that just domain is not going to be enough. Appropriate technology is very important, and contextual technology that complements domain is our focus. Then above all, operational flexibility and pretty much plug and play specialist human capital, which in many ways I think is timely given the worldwide shortage of financial talent, and given that in every financial center we are facing record high attrition. So I think, we've absolutely, as Shubro referred earlier, the company's witnessed record growth, and we think there is a combination of appreciation of flexibility in staffing, human capital at the right caliber, at the right price. That is now, I think, top of mind for many companies. Before I hand it back, let me quickly introduce our sales leaders who you could reach out to if you had any questions or follow-up after this seminar. John Lucchese, he has been with us over a decade, based in New York. Pedro Armstrong, also based in our New York office, about 21 years of experience, over 13 at Equity. And Chetan Majidya, who's based in our San Francisco office, about 20 years experience, 5 of them with Equity. And they would be happy to put you in touch with our sales leaders in Europe or Asia if your business partners in those regions were interested in any follow-up. With that, once again, on behalf of our Equity Executive Committee and everyone at this company, we sincerely thank you for your time and attention during this seminar. With that, let me open the floor for questions. Back to you, Shubham.
Thank you. Thank you, Paul. And it seems like questions are floating in. So Arvind, maybe I can direct this for you. 2021 was a very good year for CMBS issuances. What's the forecast looks like for the year ahead with slowdown expected in CMBS, defiances? Arvind, would you like to take that?
Sure. Yes, I mean, 2021 definitely was good. 2022, I think, is a very, very different story there. I think it's January, February, it started off well. We thought things, it was looking good January, February, then things changed substantially. And I think the challenge for the fixed rate CMBS industry obviously has been pretty significant on interest rates and what has happened, and this whole recalibration that is happening. Essentially, most borrowers have found move back to balance sheet lending because that was kind of not going up at the same rate as CMBS, which calibrates a lot faster. And so the CMBS industry really slowed down at that point. It's now we see it slowly coming back, and I think mostly because a lot of the balance sheet lenders are kind of full up on their balance sheet because they've been doing a lot of lending, I would say, in the first few months, first 6 months, and the opportunities are drying up. Interest rates and balance sheet also getting higher and higher, and so closer to CMBS rates. So people are looking at borrowers are back looking at CMBS now as something. We find a lot of them are focused on 5-year CMBS because they don't want to lock in long-term higher rates, because some of them feel rates will come down. It's interesting because the 10-year is pricing actually better than the 5-year pricing because the inverted yield curve right now. So we're still seeing some of them are focused on 5-year markets. So I definitely think this is going to be a much slower year. Volumes are going to be down significantly from last year on the CMBS securitization business. I think by the end of the year, hopefully there will be, and we're seeing that the expectation, the recalibrations will happen, and borrowers will again figure out, will start focusing on CMBS. We've seen SASBs are starting to pick up, so we're kind of excited, and we're again focusing on growing the CMBS business now.
No, thank you, Arvind, and thanks for that insights. And I guess questions are coming from different subject lines as well. So Ken, here is one of our attendees wants to understand what is the selection criteria for choosing a third-party transformation partner, and which areas do you start with? What's best practices you would advise? Again, the last several years of doing this. Ken, would you like to take that?
Yeah, there's a lot to unpack here, Shubro. I'll mention a few things. I mean, I've been to India multiple times going through the vendor selection process. We've looked at some of the big, large BPO firms, and we evaluated the small firms. And to kind of highlight a few of the critical things, I would say culture and organizational fit was near the top of our evaluation process. Some of the firms that we talked to, we were just a number, and they were not willing to adjust their process and their technique to match our requirements. So if that works for you, that's fine. We needed something that was unique to Key, specifically around how we managed our commercial real estate processes. You know, price is always a factor that you look at. I would just say that you get what you pay for, and that has been kind of a component of our engagement. And we are, we are price sensitive, but we also realize that you have to spend money to make money. So that's something that we look at. The other thing that we've looked at is really expertise. Now, does the firm demonstrate expertise in the area that you're looking to source? Now, we took a pretty big gamble with Acuity at the time, and this was like 4 versions before Acuity came to view. But is the firm willing to make the investment in the area of expertise that you're looking to source? And Acuity at the time brought someone in during the sales process and brought them onshore to demonstrate their knowledge of commercial real estate. So they made their investment and said that we are committed to this business, and now it's one of their largest growing business within the firm. So are they willing to commit and train their staff? Because no firm is going to know exactly what they're doing, but are they willing to commit to that? So those are the kind of 3 things that we looked at when looking at the criteria. And I could kind of go on about the reference there, and I'd be willing to do that outside of this if you'd like. I would mention a couple other things in the comment that you said. Where did you start with? Well, we did our initial sizings and our portfolio management activities and helping to support the quote creation process. So being able to take an op statement and a rent roll, extract the data either manually or through a system to be able to understand what your coverages look like from an historical perspective and take a stab at what a stabilized, net cash flow and NOI would look like. So everything that supports the initial sizing and quote creation process, along with portfolio management activities. And I would say that's allowed us to be more responsive to our clients. So we get the documents in, we send them to Acuity before we leave for the day, and we come back, all the deal's been, the entire deal has been sized up and analyzed. And so our onshore analysts can review the work that's being done offshore and then respond to our client the next day. So that's really allowed us to leverage that third shift capability and respond more quickly to our clients. And lastly, what are the best practices, I would say? And there I have about 4 or 5 of those. And first and foremost would be strong executive sponsorship, because this can be a change management issue with the staff. And our staff believes today that we would not be successful without our offshore partners. We also had daily calls when we were starting, in addition to sending people onshore and offshore to do knowledge transition sessions, really working on the workflow process, how logistically, how it would work, and the goals that you should achieve through this. We do, pre and post COVID now, make investments of sending staff to India to develop and nurture the relationships and build up the team morale that's there. So a strong knowledge provider will really know how to invest in the core team, how to source the staffing so we don't have to. And that's been one of our success factors there. And I would say lastly, just to wrap this up, is that you need to have a technology that supports the sharing of work responsibilities between onshore and offshore. To the extent it's workflow driven, all the better, but you don't want to have to email documents around. You want to be able to work with the same source. So we specifically invested in an LOS, in a loan origination system that allowed us to all work within the same system and share documents seamlessly between onshore and offshore. And so that was one of the critical success factors. So with that, I'll turn it back to you, Schroeder.
Thank you, Ken. And the journey has been fantastic. And talking about the journey, I guess we are on a touch of an hour now. Again, I would like to conclude. First of all, thank you, everyone, all our panelists. It has been absolute pleasure to be part of the discussion, as well as, thank you to our attendees. I hope, we learned a lot today together. It's been a fantastic conversation. And until next time, have a good evening, everybody. Thank you.